Commercial real estate syndication lets many investors, limited partners, to pool their funds to buy and profit from a large commercial property or properties. The general partner runs the show, does the work, typically invest a small portion of the equity capital required. Limited partners put up most of the money. They get periodic updates, distributions, financials, operating updates, etc. And they sit back and let the general partner manage everything. Hi folks, my name is Mike Zlotnik, also known as the Big Mike, and I'd like to welcome you to our quick introductory video on commercial real estate syndication, CRE syndication. It is a powerful way to invest in large real estate projects without having to go and do it alone. If you're new to CRE investing, this short video is designed for you. Appreciate your time in advance. So what is a CRE syndication? Commercial real estate syndication is a way for multiple investors to pool their money to purchase, manage, and eventually profit from the properties that would be too big to tackle it alone. These properties typically include multifamily apartment complexes, open-air shopping centers, industrial warehouses, self-storage facilities, and similar. So let's talk about various players in a syndication. The general partners and the limited partners. There are two main roles. So general partner, GP, is also known as the sponsor, the operator, the manager. The GPs typically find and secure the properties, deal sourcing and due diligence is part of that process. They typically analyze and underwrite the deal. They get the property under contract, put together capital package, and formal offering documents such as private placement memorandum as well as marketing materials. And they reach out to investors like you, limited partners. So general partner typically invests 5 to 10% of the total equity capital required. Limited partners, investors, they are passive, just like you, and they contribute, generally speaking, 90 to 95% of the total equity capital. Part of their process is to review the offering documents, the PPM, and perform their own due diligence, which includes typically due diligence on both the sponsor, the manager, the general partner, and the deal itself. And there's another video, of course, how to do the due diligence, but for the sake of this conversation, we're just going to keep it high level. And limited partners don't participate in daily management, but they receive the benefits of a passive investment, such as cash flow, tax benefits in the form of depreciation, regular project updates in the cash flow distributions, and similar. How are the commercial real estate deals financed? So most of commercial real estate deals are financed with a bank mortgage, typically 60 to 75% of the purchase price, or 60 to 75% leverage. And then they raise equity capital from investors, both limited partners and the general partner contribute to the equity capital. What is the life cycle of a commercial real estate syndication? Number one, it's acquisition. General partner secures the deal and finalizes investor capital commitments. Two, there's a closing. Once the capital is raised, everyone wires their funds in, writes a check. There's a closing process, the deal closes, and now the partnership between limited partner and general partner, or limited partners and general partner, starts as business plan. So business plan of ownership is executed by the general partner, and typically it's communicated in advance, and the general partner executes renovations, construction, property management improvements, leasing of vacant spaces or apartments, manages finances, reports taxes, compliance reporting, distributes tax documents, provides operating and financial reports on quarterly or monthly basis, periodic basis to limited partners. Cash flow and reporting is the next phase of the business cycle. So the cash flow distributions typically happen by the general partner to limited partners on periodic basis, sometimes monthly, sometimes quarterly. Reporting typically includes operating and financial reports, as well as the tax compliance, as I mentioned. Disposition is the phase of the project when the property is ready to be sold. So property gets marketed, General partner secures a buyer, sells the property, and as part of the process, general partner pays off the mortgage, returns investors, limited partners their original invested capital, and then splits the profits as per the terms of the PPM. Different PPMs may have different terms, but as an example, investors may receive certain level of preferred returns, and then profits above preferred returns could be split. For example, a split could be 80-20, 80% to investors, 20% to the sponsor, or 70-30. So the sponsor receives the 20 or 30% as a performance fee for getting investors their capital, getting a preferred return. It's their alignment of interest fee, performance fee. It's normal, typical, and common for the general partner to receive those benefits as a result of their work. Next, what are the benefits to limited partners? So limited partners generally receive passive income. It could be quarterly distributions as well as back-end capital gains, profits split. There's a cash flow and appreciation without the management headaches. That's one of the key benefits. Diversification. Investors get to participate with relatively smaller amount of capital in a larger properties. They can hedge their risk and spread it among multiple projects. Next, there can be expert management. General partners or sponsors, operators, managers typically have years of expertise. They bring their teams, experience, supply chain, property management, leasing, and other expertise to move the deal through its business plan. Limited partners typically have no liability. Their liability is limited, and their risk exposure is limited to the capital they contributed to the deal. And then they also receive the tax benefits. Typically, it could be depreciation, amortization, bonus depreciation, and other tax efficiency, and the gains could be taxed as capital gains. So generally, these type of investments, real estate, are very tax-friendly, tax-efficient. Real estate is one of the most tax-advantaged asset classes to invest into. So quick recap. Commercial real estate syndication lets many investors, limited partners, to pool their funds to buy and profit from a large commercial property or properties. The general partner runs the show, does the work, typically invest a small portion of the equity capital required. Limited partners put up most of the money. They get periodic updates, distributions, financials, operating updates, etc. And they sit back and let the general partner manage everything. As a limited partner, you can enjoy the benefits of investing in real estate without active participation. Essentially, you are a passive investor and you're enjoying investing in real estate through that passive lens. Appreciate your time and attention. Until the next time, thank you.